SpaceX IPO buyers didn't make a financial mistake. They made a psychology mistake. Big difference. And there's one specific cognitive error at the center of this, one that most financial commentators won't name directly, that I'm going to show you by the end of this video. Because if you can see it clearly, it will change how you make every high-conviction trade after this. When SpaceX shares hit the public market, the narrative was simple. You're either in or you're out. This is the rocket company. This is Elon. This is history. Get in now or watch from the sidelines forever. That story is doing a lot of work, and none of it has anything to do with valuation. Here's what people think happened. Retail investors got a rare chance to buy into a generational company. Here's what actually happened. They got access to an asset that institutions had already repriced over years of private funding, and they paid a premium for the privilege of going last. 2 days after the IPO, the average buyer is nearly underwater, not because SpaceX is a bad company, because the moment something becomes available to retail investors, when the hype has already been priced in by institutions over years of private funding, the emotional premium you're paying has nowhere to go but down. And the reason the premium exists, the mechanics of exactly how it gets built into the price before you ever see it, that's something I want to walk you through specifically because it's not obvious, and once you see it, you cannot unsee it. That's the problem nobody names in the moment, they name it after. Here's what this looks like in real numbers. SpaceX was valued at roughly $350 billion in its most recent private rounds before the IPO. By the time retail buyers got access, they were paying a price that already reflected years of growth expectations baked in by venture capital, sovereign wealth funds, and institutional investors who got in at a fraction of that price. Stop. Let that land for a second. The institutions weren't smarter. They were just earlier. And earlier in this game is the entire ballgame. When the stock slipped in the first 2 trading days, even a modest drop of 3 to 5%, buyers who put in $50,000 are looking at being down $1,500 to $2,500. Put in $100,000, and that's $3,000 to $5,000 gone in 48 hours. That is a family holiday. That is 3 months of groceries. That is real money evaporating from a position most people entered feeling completely certain about. And here's where it gets worse. Most of them didn't plan for that. They assumed the trade would move up immediately because the company is great. And that assumption is where the real damage lives. Not in the loss itself, in what the loss does to their decision-making next. Because there's a sequence of decisions that typically follows a loss like this, a predictable chain reaction, and I want to describe it to you precisely, because recognizing it in yourself in real time is the only way to stop it. I'll get to that sequence in a moment. Because when you're down on a trade you are emotionally certain about, you don't think clearly, you hold too long, or you panic sell, or you double down trying to recover. Every one of those reactions costs more than the original loss, and by the time you realize what happened, the psychology has already done its work. Here's something most people don't know about IPOs. On average, retail investors underperform institutional investors in IPO trades by a wide margin, not because institutions are smarter, but because institutions often get allocated shares at the offering price before trading begins. Retail buyers get in after the open, when the initial pop has already happened. A study from Jay Ritter at the University of Florida, he's tracked IPO performance for decades, found that in the 3 years following their IPO, the average company underperforms the broader market by about 20%. Not every company, but on average, that's the number. Now here's the twist, and I want you to stop and actually sit with this, because most people hear that statistic and immediately draw the wrong conclusion. And the wrong conclusion is going to cost you more than the right one would have saved you. Most people think, so SpaceX is going to crash. That's not what the data says. What it says is far more unsettling, and far more useful if you're willing to hear it honestly. The more unsettling possibility is this: SpaceX could do exactly what everyone expects. Grow, dominate, become one of the great companies of the century, and still punish the average retail buyer. Not because the company failed, because the entry price was already pricing in years of success that hasn't happened yet. The real risk was never the company. It was the psychology that convinced you the entry price didn't matter as long as the story was good enough. That's the trap. And it's invisible right up until you're in it. You're not buying the company. You're buying the story at full retail markup. And the story being extraordinary doesn't mean the price is right. There's a name for this gap between what a stock is worth on fundamentals and what people pay because the mission excites them. And it has a specific mechanism that I want to explain, because understanding the mechanism is what lets you spot it before you're holding the bag. This is called the IPO premium, the gap between what a stock is worth based on earnings and cash flow, and what people are willing to pay because they believe in the mission. SpaceX's mission is genuinely extraordinary. But extraordinary missions and extraordinary returns for IPO buyers are two completely different things. One does not guarantee the other. Now here's the part most people miss, and it's actually more interesting than the IPO mechanics. SpaceX buyers weren't irrational, they were predictable. And predictable is almost worse, because it means the outcome was foreseeable, which means it was preventable. There's a well-documented psychological pattern called FOMO-driven anchoring. It works like this. You hear about an investment opportunity and your brain immediately anchors to the upside scenario. The version where you got in early, the stock doubled, and you were right. That anchor becomes your emotional reference point. Everything after that is measured against it. People think they're evaluating a trade. They're actually defending a fantasy they formed in the first 30 seconds of hearing about it. So when the stock drops 2%, you're not comparing it to your actual cost basis and thinking about risk. You're comparing it to the imaginary version where it went up 30%. And that gap between the fantasy return and the real loss feels like a personal failure, not a market event. That's why people make bad decisions after IPO drops specifically. It's not the money, it's the identity. You told yourself a story about being the kind of person who gets into good things early. The loss threatens that story. And you'll do financially irrational things to protect the story. I want to show you exactly what that looks like in practice. There's a specific person I want to tell you about. His decisions over 4 days will make this more concrete than any theory I can hand you. That's coming right now. I want to tell you about someone. I'll call him Marcus. He's not a reckless person. He's an engineer in his late 30s, careful with money, done his research. He put $80,000 into the SpaceX IPO, money he had specifically set aside for a high-conviction trade. He believed in the mission. He had read the filings. He felt prepared. He did everything right, except the one thing that actually mattered. Day 1, the stock dipped. He held because he believed in the company. Day 2, it dipped again. He told himself this was just volatility. The market was wrong, not him. By day 4, down 7% on $80,000, nearly $6,000, he started to panic. But selling felt like admitting he'd been wrong about something he publicly told his friends was a sure thing. So he doubled down instead, bought more on the dip to lower his average. And then the stock drifted sideways for 6 weeks, doing nothing until he finally sold in frustration, just before the price recovered. Marcus didn't lose because SpaceX was a bad company. He lost because he collapsed two completely separate questions into one feeling. Is this a great company, and is this a great price right now? He never asked the second question. And by the time he was down, his ego was so tangled up in the position that he couldn't think clearly about either one. That pattern has a name. And naming it correctly, not just vaguely calling it emotional investing, is what gives you the lever to actually change the behavior. I'll give you the name and the practical fix in a moment, but I want to make sure the shape of it is completely clear first. It's called conviction bias, the mistake of treating your belief in a mission as a substitute for a price analysis. And it doesn't just live in IPO trades. It's why people hold losing stocks because they still believe in the CEO. It's why they buy crypto at the top of a news cycle. It's why selling feels like betrayal instead of strategy. People think they're being disciplined when they hold through a loss because they believe in the company. What they're actually doing is protecting their ego at the expense of their portfolio. The SpaceX buyers who are almost underwater right now didn't make a mistake about SpaceX. They made a mistake about themselves. They didn't separate their conviction about the company from their analysis of the price. And when those two things collapse into one feeling, you're not investing, you're expressing loyalty. Loyalty is expensive. So what do you actually do with this? Here's where I close every loop I've opened, and there are several, because there's a practical answer, and practical is the only thing that earns your time. The psychology mistake, the one this whole video has been circling, is conviction bias. Letting the quality of a story override the discipline of a price framework. And the antidote is forcing those two things apart before you act, not after you're down. 1. Before you buy into any hyped asset, IPO, trending stock, hot crypto, write down separately what you believe about the company and what you believe about the price. Force those to be two different answers. If you can't justify the price independently of the story, you're buying the story. Know that going in. 2. Set a rule before you buy, not after. Decide the price at which you're wrong before you own it. If SpaceX drops 15%, is your thesis broken or just shaken? If you can't answer that before you buy, you have no plan, you just have hope. 3. Size for the reality of IPO volatility. If a 5% drop on your position, the kind of move that happened in the first 2 days of SpaceX trading, would cause you to lose sleep or make a reactive decision, you size the position too large for your psychology. The position size isn't just a financial decision, it's a psychological one. And there's a fourth consideration, one that doesn't fit neatly into a numbered framework, but that I'd argue is the most important of all for anyone who's currently sitting in a losing IPO position right now. I'll get to that in just a second. These aren't complicated rules. They're just rules most people skip because applying them before the trade requires admitting uncertainty. And uncertainty doesn't feel as good as conviction. That fourth consideration, for anyone already holding and already down, is this: the question is no longer whether the entry price was right. That's done. The only question now is whether you would buy this asset at this price with this position size today as a fresh decision with no history. If the answer is no, that's your answer. The loss already happened. Holding doesn't undo it, it just delays the accounting. Here's what you actually have now that most people watching the SpaceX coverage don't. You know the Ritter data, you understand IPO premium, you can name conviction bias. You have a 3-part framework: separate story from price, set your exit rule before you buy, size for your psychology. That most retail investors never develop because nobody hands it to them clearly. They learn it the expensive way, the way Marcus did. You just learned it for free, before the trade. SpaceX might be the most important company of this century. It might produce extraordinary long-term returns for patient, disciplined buyers who enter at the right price with a clear plan. None of that contradicts anything said here. Great company and right entry price are just two different questions. Knowing to ask both, and in what order, is one of the highest value habits in personal finance. Not the most exciting, the most valuable. If this kind of money psychology changes how you think about your own decisions, subscribe. There's a lot more of this to dig into, and drop a comment telling me what you want me to cover next. I read them, and they genuinely shape what I make.